Everyone, welcome to our presentation. We're doing Charles Schwab. I'm here with Jennifer, Irene, James, myself, and Ibrahim to tell you guys a little bit more about the company and compare it to a few of the competitors in the industry. So getting into our presentation, we'll have 6 different things that we're going to touch on, cumulative returns, share repurchase information, dividend policy, and financial analysis. We're going to have a little strategic planning, a risk management section, and then wrap it up at the end with a conclusion. So the first topic we're going to touch on are 5-year total cumulative returns with our company and a competitor. So using Yahoo Finance historical data, Charles Schwab has a 2.01 average monthly return over that 5-year span. They have an 182.6 total cumulative return over that 5-year span. Goldman Sachs has a 1.6 average monthly return over that period and 124.7 total cumulative return. Now, it's important to note that both of these companies have outperformed the S&P 500 over that same 5-year period. The S&P sits about a 93% total cumulative return. So both of these competitors have outperformed the market over that time.
Okay, so a bit of information on share repurchasing. So at the beginning of 2019, the board of directors authorized a $4 billion stock repurchase program. And there's no expiration date, so this could happen in different increments and sort of whenever they felt like exercising this. So in that year of 2019, the company repurchased about half of their allowance, and this equated to about 55 million shares. In 2020, it was unclear as to whether they were going to make plans to do so, but because of COVID-19, there was a significant drop in their Tier 1 leverage ratio, and this is just their total capital over their assets. And so there were no plans in the report to make any sort of new repurchases, and throughout the rest of the year, they didn't make any repurchases. So you still have that 1.8 billion, just the 4 billion minus the 2.2, and this is outstanding and can be exercised sort of at any point for new share repurchases.
Now, to start with the dividend policy for Charles Schwab, the Charles Schwab pays an annual dividend of 0.72 per share with a dividend yield of 1.07%. Schwab has grown its dividend for the last 1 consecutive years and is increasing its dividend by an average of 31.04 each year. The Charles Schwab pays out 26.47% of its earning out as a dividend. So the dividend frequency for Charles Schwab is a quarterly dividend, and the most recent increase was $0.01 in 1/29/2020. However, Goldman Sachs' dividend policy was that Goldman Sachs has to pay an annual dividend of $5 per share with a dividend yield of 1.47%. Goldman Sachs has grown its dividend for the last 1 consecutive years, and it is increasing its dividend by an average of 19.91% each year. The company pays out 23.78% of its earnings out as a dividend. The frequency is also the same, quarterly dividend, and we had a $0.4 increase in 7/16/2019. Now, here to explain this chart shows the revenues of Goldman Sachs versus Charles Schwab. As you can see, the green trend line is the revenue for Charles Schwab, and the white trend line is the Goldman Sachs revenue. We saw a lot of a steady increase in revenues from 2017 to 2020, but Goldman Sachs plateaued at $54 billion in 2020, where we saw a slight decrease in revenue after 2020. Now, going over the earnings per share graph of Goldman Sachs versus Charles Schwab, we saw that in December 2017, the earnings per share for Goldman Sachs plummeted, and that was because a big frenzy scheme that took over in Malaysia. It was called the 1MDB, and where almost 1 billion disappeared overnight. The company was under a lot of sell pressure. However, the stock was doing great after 2017. Moreover, the Charles Schwab earning per share was seeing a lot of healthy and steady increase until we went through pandemic, and the earnings per share decreased in 2020 for almost 20%. Now, the quarterly stock price of Goldman Sachs and Charles Schwab were being traded sideways from 2016 to 2020 up until we hit the pandemic. There was a lot of selling pressure in the market. But however, the American government acted really fast, and they passed the rescue plan where they gave out a lot of stimulus and bailed a lot of companies. This contributed to the increase of the stock prices for both Charles Schwab and Goldman Sachs to reach their all-time high. Now I will be explaining the five-way DuPont analysis. The tax burden, the adjustment factor, and the operating margin, both combined represent the net profit margin. An increase in the return on equity will increase the operating efficiency and asset management efficiency, which means that the company is in a good financial health. As you can see, Charles Schwab return on equity has been increasing up until 2020. This decline in return on equity goes back to the lower leverage ratio. A higher financial leverage will always be associated with a higher risk. So I guess Charles Schwab was trying to downplay this high risk. Now, speaking of Goldman Sachs, we can see that the return on equity has been fluctuating between 9 and 10. Which also shows that the company is in a good financial health.
A fintech firm long before the word fintech was coined, Charles Schwab offers everything from bank accounts to mutual funds to wealthy advisory platforms, reeling in more than 100,000 clients a month. To stay on top, Schwab and his company embraces a no trades-off approach, which simply means they give customers everything they want as cheaply as possible. With Charles Schwab's mobile app, for example, you can streamline essentials by using your finger, Face ID, or preset passcode to quickly check your portfolio balance, holdings, and statements. You can even access your non-Schwab accounts through the same platform. You have the capabilities to customize your experience by organizing your summary view and market settings to prioritize the information you need. You can set text alerts and push notifications to help you stay on top of your accounts and investments. Charles Schwab's fintech services allows you to place trades and monitor your opportunities 24/7. You can see your positions at a glance, as well as trade stocks, ETFs, mutual funds, and options. Now, one of the biggest changes we've seen recently in 2020 was the addition of offering free digital financial planning for all Schwab clients, regardless of their asset level. Through a self-guided process, clients build a personalized plan to be able to see retirement goals and their probability of funding those goals, compare current asset allocations to recommendations based on their plan inputs, and suggested next steps to nudge them towards the optimal course of action. Now, since the beginning, Charles Schwab was created with a focus on customer service. To better align their mission statement of empowering clients to take ownership of their financial future, they built artificial intelligence technology to better serve their consumers. The Schwab Assistant recognizes voice commands so you can conveniently get your financial businesses sorted more quickly and efficiently. You can speak to the intelligent assistant to make trades, get quotes, manage investments, and so on. It uses machine learning, so the Schwab Assistant will continue to improve, adapt, and get smarter the more clients interact with it. Of course, the cost of bringing financial transaction processing to the mainframe era into the cloud era is enormous. For companies to survive, they must do it at scale, so the costs are spread out. To meet this demand, Charles Schwab has acquired several fintech corporations, including its most notable merge with TD Ameritrade. In 2020, Charles Schwab completed the acquisition of Motive's technology capabilities, and during the same time frame, launched a new retirement planning tool, Schwab Intelligent Income. Schwab Intelligent Income is a new digital service for people nearing retirement that will help answer income-related questions about how much to withdraw, how to invest based on individual goals and time horizon, and how to withdraw from a combination of taxable, non-taxable, and Roth accounts in a smart, tax, and efficient way.
Charles Schwab has many policies and regulations in place to assist its risk management. The company has three main lines of defense when it comes to risk management. Business line, which helps identify, assess, and manage risks. Independent, which oversee and contribute to the effective risk management practice across the organization. Internal audit, which helps the board and senior management protect the assets, reputation, and sustainability of the company. Charles Schwab has also implemented an operational risk management framework that is meant to maximize value within risk tolerance and is a repeatable operational risk lifecycle. Charles Schwab has also a nominating corporate government committee which conducts annual reviews of the risk policies and guidance to reevaluate the functions and needs of the company and stakeholders. And finally, our buy, sell, or hold recommendation. Based on our group's astute analysis, we are recommending a buy rating for Charles Schwab. That concludes our presentation. Thanks for watching.
Thanks, everyone.